Now, there are many pieces to trading, and the one that we're going to discuss today is it's just another piece in the puzzle that you need. But before I get started here, I actually put together a brand new chart pattern guide to help you navigate around some of the more popular patterns out there. It's totally free, no charge, no credit card needed, and the link is above this video and below in the description. Now, every single trader out there, they should be trading with a plan that highlights pretty important things such as what's your trade setup, so what's your trading strategy, how you enter a trade, which is a trade trigger, and where your stop loss is placed, which is managing your risk. Now, there are a lot of ways to define a trading setup, but regardless of which one you're going to use, you need a way to enter that trade. Now, we don't want to just hit the buy or sell buttons. What we do want to do is ensure that there's something telling us that our setup is going to be or has a chance to be successful. So having a proper way to determine an entry point in the market is going to determine how well you do with trading opportunities when they present themselves. So what's your setup? Now, I'm not going to go on about trading setups here. I got a lot of stuff on our YouTube channel, but we do need to use one to demonstrate how to enter a trade. So we could use a pullback to a moving average. We could use breakouts. We could use trading support and resistance. So I'm going to use a simple support and resistance trade setup. And what we're looking for is rejection of those levels in the direction of the overall trend. And I'm going to use Forex here as an example, but any liquid instrument should be fine. So using price determination of trend, which is for a downtrend, lower highs and lower lows, here's our downtrend. So we're going to be looking for selling opportunities when price finds resistance levels during the pullback. So to keep it simple, you want to just look for areas that are pretty obvious in the swings. But when you see the trend price pattern stall, so our higher lows and higher highs are turning into higher lows, for example, start looking for a trading range. I got a video linked up here on the right. So once price meets a resistance level, do we just use that as an entry point? Well, the answer is no, because price can and does routinely slice right through those levels. So you would not have a setup. So what we need to have is another step before we hit the buttons. So when we're using support and resistance for trading in a trending market, we're essentially using a pullback type of strategy. So instead of us using a moving average as a target for the pullback, we are using price levels that formed what could be a potential turning point in the market. So our job is to see if there's a high probability of the level holding instead of breaking. So how do we do that? We can use technical indicators. We can use price action. We can even use breaks of price patterns. But what's important is that whatever you use, that it shows up in your trading plan that you've designed and you've tested. Because honestly, nothing can kill your progress like lack of consistency. So you really want to ensure that you follow up. So the first one is technical indicators. And there are a whole lot of methods as there are technical indicators. So let's keep it to a few simple ideas. We can look at a zero line cross. We can look at slow and fast line crosses. We can look for a indicator leaving an oversold or overbought condition. And you also have the option of using multiple time frames, which would be your trading time frame, and a lower one, which would be your trade entry time frame. So for this example, I'm just going to use the stochastics, the two-line cross. I'm going to use RSI for oversold or overbought, and the CCI is going to use it for a zero-line crossover. Now, on both of these setups here, the two-line cross of the stochastics beats the CCI by at least 5 bars, and this is an hourly chart, so 5 hours. And the RSI, well, that never reached the overbought on this particular time frame. Now, if we go to a 15-minute chart, the two-line cross is still the winner, but there's a bit of a trade-off when you go lower. You may see your stop loss hit. Now, that depends on how you determine where to place your stop. When you're using lower time frames, we start to see more peaks and valleys that we don't see in the higher time frame charts. So needing the indicator to make a signal plus a break of a previous swing high or a swing low could be something to consider when looking to enter the market. Now, you also have the option of using a stop order, which is a pending order, to enter the market at the break of the lows of the candlestick in a downtrend that turn that indicator to give a trigger. And what this will do will trigger you in when price moves in your direction, which shows, at least temporarily, that there's some momentum in your direction. Now, what about price action? Well, when you use price action, that's going to require you to see when the balance of power is shifting from the buyers to sellers or reverse, just through looking at the price. Here, this is known as a pin bar. Price breaks below this support level, and lower prices are quickly rejected. And I personally use the term spring when I talk about this kind of formation. Now, traders would either enter on the close of the candle or when price breaks the high of that reversal bar. The stop loss location, generally it's below the low of the reversal. Now, your profit target, that's going to depend on you. But if you just look at previous highs, in the case of a buy, it's not a bad place to start to monitor the evolution of the price to see if it starts to stall. You can also look at using engulfing candlesticks as a means of getting into a trade, both bullish engulfing and bearish engulfing for shorts, obviously, shows a decided change in market state, especially when you're looking at important swing points. Now, 2 and 3 bar reversals. Now, these are trade entries that I find more reliable than a single bar reversal. And the first one here is a 2 bar reversal. Here we have a resistance zone, and this is a stock of Starbucks. And I labeled 2 candlesticks. So here's what we're looking for. Number 1, this is our trigger setup candlestick. So we need to see the next candlestick break the high of the candlestick and then close below the low of number 1 candle. So here, the number 2 candle clears the high of candle number 1. And in the same 15-minute candle, price closes below the close of the number 1 candlestick. And you can enter at the close or break of the low of candlestick number 2. So the 3 bar reversal, price pulled back into a support zone. And now we're going to look for our trigger. So the main difference is where the price closes. So number 1 is still our trigger setup candle. Number 2, price washes out the low of number 1. And if price closes above the close of number 1, we have our 2 bar reversal, but price closes lower. Number 3, this is our trigger candlestick because once it closes above the close of the first candlestick, that's our entry. Now, if we need 4 candlesticks, it's not going to be valid, right? So maybe you want to sit down on that trade. So if the close of number 3 does not close above the close of number 1, you need a different entry to trade. Price patterns. Now, when using price patterns, I generally use a lower time frame. And this is dependent on what price does at the support level, of course, but it's a standard part of the plan. Now, the most utilized pattern for a trade entry would be a breakout of lower time frame ranges to enter a higher time frame pullback. Now, I don't want you to be confused with a breakout trading strategy. Okay, it's an entry trigger, and you would use the higher time frame pattern for your stop loss location. This is a daily chart up here on the left, and it shows a pullback into support. Going to a 4-hour chart, we actually have 2 entries. Number 1 is the one on the left, and that's actually our 3 bar entry. On the right is where we see price form a trading range. Now traders can set a buy stop order with the entry level being just above that resistance line. Your stop loss can go either below the range or the low on the left. That depends on the risk reward ratio and your position sizing, of course. The stop loss location has to fit the higher time frame chart. And it does here because the lows are pretty much the same. So when you're setting up both your stop and your take profit orders, use the setup chart time frame, the higher one, for those prices. All right, so let's wrap this up. This is obviously not an exhaustive list of entering a trade, but it does give you something to start investigating. Now, I suggest use a trading log to write down your results with the different tactics that you're going to test for entry, and that can help you zero in on something that you can use. When you look at an order type, limit orders will not work on these trade entries because we're looking for price to move in our direction before we enter the trade. So the pending order in the form of a stop order will work. Now, a successful trade, it's going to require more than just your entry. But having a set criteria for when your trading setup occurs can actually assist you in profitable trades. And not every trade is going to be a winner. but we can put the odds in our favor with a disciplined approach to putting risk on in the market. If you have any questions, you can put them in below. Need some clarification, feel free to do the same.